Welcome to Talk Tickers, where we dive deep into the latest earnings calls. Today we're breaking down Ally Financial's fourth quarter results, which they reported on January 21st, 2026.
So, Ally's report gave us a classic Wall Street puzzle. The headline numbers look pretty good, but the stock took an immediate dive. It's the kind of thing that makes you go,
And by good, I mean they beat expectations. They reported adjusted earnings per share of $1.09, which was 6 cents better than the 103 analysts were looking for. A solid beat.
But, and this is the big but, despite that good news, the stock dropped almost 4% in pre-market trading right after the numbers came out. So what in the world is going on here?
All right, here's how we're going to unpack this. First, we'll look at that headline beat. Then, we're going to dig beneath the surface to the real operating story. After that, we'll analyze their forward guidance, unpack the market's reaction, and finally, we'll give you our take.
Okay, so first up, let's talk about those numbers that, on the surface, looked so good.
As you can see, Ally really did clear the bar. They beat on earnings, they squeaked by on revenue, and they even posted some decent year-over-year growth. So on paper, it looks like a clear win.
But you know the market. It always looks past the headlines. What really matters is the underlying story, the nuts and bolts of the operation. And these are the metrics that tell that real story. You've got net interest margin. That's basically their core profitability on loans. Then you've got their credit losses, the charge-offs from their huge auto loan business, and finally return on equity, which is the big picture measure of profitability. This is the real engine room of the company. So management's whole story on the call was all about discipline. They kept saying, look, we're controlling our credit risk, we're protecting our profit margins, and that's going to set us up for better returns down the road. Basically, they're telling the market they're focused on quality, not just quantity.
And that brings us to the forward look. This is so important because the market wasn't trading what happened last quarter. No way. It was trading on the promise of what's going to happen next year.
And here is the plan they laid out. They're telling investors to expect a big jump in returns. But it all, and I mean all of it, hinges on two things: keeping those profit margins stable and making sure their credit losses stay inside this very specific window. That's the core promise for 2026.
You could really feel the tension during the Q&A session. The analysts, they weren't asking about the Q4 beat. They were drilling down on all the risks to that 2026 guidance. They were asking, how exactly are you going to hit these targets?
Which brings us right back to that million-dollar question. If they beat earnings, why did the stock sell off? And here's the answer. It's all about uncertainty. Investors heard the promises for next year, but they got fixated on the risks around credit, around funding costs, and they basically said, we need more proof before we're willing to pay more for this stock. The reaction was decisive. Just look at the trading volume. It spiked to 3 times the daily average. That's not just a few people selling, that's a strong signal that the big institutional money was making a move based on that new guidance. So the bottom line here? The market is playing a game of prove it. You had management telling this story of rebuilding and improving, but the stock price was telling a totally different story. That creates a credibility gap, and now Ally has to spend the next few quarters closing it.
Okay, so let's put this all together. Here's our call on Ally Financial going forward.
We're predicting more volatility in the near term, for sure. The market is now going to be watching every single data point on credit losses and profit margins like a hawk, comparing it right back to that 2026 guide. Any little deviation is going to get punished.
So what does this mean for the stock price? We expect it to be range-bound, kind of stuck in a rut. There's not going to be a big breakout until there is clear, quarter-after-quarter evidence that both their margins and their credit losses are tracking right where management said they would.
So our rating on the stock is market perform. The company itself seems to be on the right track operationally, but the stock just doesn't have a big reason to outperform the rest of the market until investors have a lot more confidence in that future story.
And finally, just one last crucial point. This is not financial advice.